So I was asking the first question to Aditya. Like when somebody new comes to the market, or talk about investment, the thoughts that comes to his mind is investing is risky, it's gambling. Investing needs lots of knowledge, and it needs lots of money. So Aditya, if you can just demystify those myths to our new investors.
Yeah. So, anyone who invests first in the market, let me make it very clear: markets are not gambling. It is not a casino, or it is not something where you invest for quick returns. That is there. Point number one. It is gambling or a casino only when you are looking to double your money in a short period of time. That is there, or to get superior returns in short period of time. When you invest, first of all, why do you invest? You invest because in the later years of your life, you may have some goals. You may have some goals,
Mhm.
and to achieve those goals, you may require certain amount of money that is there, and that can be done with the help of certain investment tools that are there, and those tools can help you generate the returns that you want. That's the first point. The second point that is that as soon as you enter the equity, as soon as you enter into the investment world, there are n number of products that are there. You have to be first very disciplined and very systematic in the approach that you take. I, for one, being a financial planner as well as an equity analyst as well as a mutual fund advisor, suggest to all retail investors who are joining for the who are investing in the markets for the first time. When you get your first salary, try to create a financial plan. Try to have some goals and link those goals to the investments that you make. Once you have an insurance in place, the number one thing that you need to do when you enter the markets is have an insurance in place, then go and have an emergency corpus in place, then have an asset allocation, and that asset allocation will help you invest in various asset classes like equity, debt, real estate, and gold. And within equities and debt, you have something known as a mutual fund. So, what is a mutual fund? It will pool money of a lot of small retail investors, and there will be an asset manager who will try to invest that money into good avenues where he thinks it is good and he can generate good amount of returns, and uh, he will charge certain amount of fee for it and give the rest of the returns back to the investors. It is a very good investment tool. It brings down the cost of asset management. If you go and do it one on one with an advisor, the costs will be much higher. So, mutual funds are a great option. They're not a great option if you want to invest. I'm just talking about equity mutual funds here. They're not a great investment if you're wanting to get returns within 1 to 3 years. However, if you want to go ahead and compound your money, create good amounts of return over a period of 5, 7, 10 years, then you will find mutual funds are great options. We have seen mutual funds right from 2000s right up till now creating huge amounts of wealth. So it is not gambling. It is only for those who are very systematic and disciplined in their investment behavior. And we have seen 99.99% people are not systematic and disciplined. Therefore, point number one to all young retail investors and even to those who are not young, try to be very disciplined. Try to not have emotions attached to anything. SIP your way for at least 10 to 15 years, and then you will find mutual funds are a great option to invest in.
Thank you, Aditya. In fact, my next question is for Chirag. Most of the people actually misunderstand the word risk. The risk is always associated whatever we do in our life. So, can you uh, throw some light on the risk and return, these two terminologies to our participants? What exactly is the meaning of risk, and how it can be managed, and how it can be handled, and what return actually is a fair return? If you can give a idea to our listeners.
Sure, Neeraj. I mean, risk and return are just two sides of the same coin. I mean, if you want a higher return, you need to take higher risk. But the flip side is not true. If you take higher risk, does not mean that you will get higher return. So you have to very well understand that. And what is real risk? Real risk is a complete loss of capital. any money that you have invested, any part or entire money that you lose, is the real risk that you should look at. Many people ascribe volatility, which is nothing but ups and down movements in asset markets, as risk. Is that risk? No. If you wait, that is part and parcel of any investment that you do. There will be ups and downs in any asset class that you invest in. There will be good times when you make higher returns, and there will be bad times when you make negative returns. When you have a longer time period, you will be able to get over that volatility risk. But if you choose a wrong investment, if you invest in something that you don't have not understood well in terms of risk, there could be a complete loss of capital, which is where you need to protect. For example, if you invest in companies which does not have good governance, which does not have good management. Business may look good today, but businesses grow through cycles. If the management and is not able to turn around the businesses at the right time, you may face that loss of capital that you're looking for. So overall, you have to take into consideration that to avoid that capital loss at all cost. And when it comes to volatility, you may not be able to see at times equities can fall by, say, in a given period, fall by 20, 30, 40%. Like, for example, in COVID period, equities fell by more than 40% in just about 1 month's time. So if you are not able to take those kind of down moves and see your portfolio erode such high amount of sees high amount of losses, then probably you need to diversify. And you have to diversify because at any given point in time, like Aditya said, you are planning for a goal, and that goal happens to be a period which is coinciding with, say, a global financial crisis when equities were down 50%, during the COVID period when equities were down by more than 40%. Then you don't have enough money to pay for your financial goal or a requirement that you had for money. So it is essential that you diversify your investments into different asset classes. Keep some emergency corpus with you so that you do not change your investment discipline that you have had, and it allows you to compound your wealth even during times of medical emergency or any other emergency that you have today. Maybe it could be a job loss or a loss in business. Then you are prepared with an emergency corpus. So start with an emergency corpus. We recommend that you at least have 12 months of expenses as emergency corpus. It could be more if you think that you are conservative and you need to have more buffer, or if your cash flows are not certain, then you need to build that buffer. So 12 to 24 months of your expenses is a good emergency corpus. And post that, you could split that money into equities and gold kind of assets. Why gold? Because gold is a great diversifier. And when we have seen that, whenever equity markets have seen losses, usually gold has seen positive returns. For example, global financial crisis, equities down 50%, gold up 30%. Even during the year of COVID, gold was the best performing asset class out there. So equities are great for long term wealth creation, but you need to balance it out with assets that are diversified and that will help you during when equity markets are seeing losses. So don't worry about jargons thrown at you from a risk perspective. Understand that you need to be very aware of where you invest in sensible way, and and if you diversify, I think you are good for the long term wealth creation.
Great, great. Thank you, Chirag. In fact, Chirag has mentioned about emergency fund. You need to have emergency funds. So there are certain things, where before I start my investment journey, I need to, consider before I start. What are those particular things? It's not that whatever salary that I get, whatever savings that I have, I put that money straightway to my investment. I buy some equity. But again, before buying some equity or mutual fund, I need to take care of certain things. So, what are those things? Can you just, Aditya, top five things that you need to consider, or anybody need to consider before he actually start his investing journey?
It is incorrect to say that whenever you save, you have to go and first invest in equity. Absolutely not. When you first save your money, the first thing that you need to do is invest in insurance, both health insurance and as well as if your life situation is such that you require a term insurance, that's the first thing from your first saving that you need to buy. Then the second thing that you need to do is create an emergency corpus which can be anywhere between 12 months or 18 months of your expenses that is there. So in case of any emergency, it will take care of all the expenses that you may have. For example, many people lost their jobs when the first COVID-19 crisis hit and there was a lockdown. So what that emergency corpus does is that in case you don't have an inflow of money, you can withdraw money from there and carry your day-to-day expenses as long as you are trying to look for a new job. That second. Third, what you need to really do is uh, this is all part of financial planning. So the third thing that you need to really do is figure out what your goals really are. Your goals could be retirement, your goals could be your child's education, your goals could be your child's marriage, or anything. It could be buying a house as well. So any of those goals you need to first decipher. Once you have done that, then there's a thing called risk profiling. On the risk profiling, you will be able to see how much risk are you able to tolerate, and what is your ability to take risk inside the market. By risk, I mean allocation to riskier asset classes such as equities. Equities are riskier in the short term. In the long term, they become less and less risky as the time horizon increases. Right. Then comes the most important part of this process. It is asset allocation. So, what do I mean by asset allocation? As Chirag just said, never put your eggs in one basket. Your all of your money should be split into multiple assets that are there. So, what are the four prominent asset classes? It's equity, it's debt, it's real estate, and gold. These are the four prominent asset classes that are there. You have to diversify into all of those four asset classes. So, what a risk profile will do, it will tell you how much money to put where. For example, when you are very, very young, you invest aggressively into equities. Your asset allocation is tilted towards equities. When you are very, very old, your asset allocation is tilted towards debt. Why is it so? Because at that point in time, you have accumulated a lot of corpus and you require fixed income then, right? So once you have done asset allocation, then you go ahead and start and invest in equities. Um, for example, if you have 20 to 30% to invest in equities, you can go ahead and invest through multiple routes. Mutual funds are the best investment options for retail investors, and there are two or three other options like a SIB RIA or a PMS. However, for retail investors, you can go ahead and invest in a mutual fund. It's a great option to invest. And number one thing when you first save is not to go ahead and invest in equity, is to go through all of these processes so that you are set up for the next 10, 15, 20 years.
Great. Thanks, Aditya. Yeah, go ahead.
Done.
Okay. Okay. In fact, you have spoken about lots of things: asset allocation, risk profiling, etc., etc. Now, again, lots of people tend to, invest in direct equity. So, of course, there are lots of risk also. But again, we retail traders or first-time investors, they tend to get carried away by the opinion of somebody else. They say that okay, ये stock खरीद लो, ये बढ़ जाएगा, double हो जाएगा, triple हो जाएगा. Now, Chirag, can you just tell our listeners how a mutual fund investing probably a better way of investing for a new investor than a direct equity? So, what are the pros and cons of investing in a direct equity vis-a-vis mutual funds? Why one should be choosing mutual funds as a source of or as a first investment, investment? Chirag, yeah.
Sure, Neeraj. Yeah, sure, Neeraj. So first, I will completely agree with what you said. Is where and how one invest should be driven by discipline and study, and not a function of what is fashionable or what your friend or neighbor is doing. It shouldn't depend on that. That's the real risk that we were talking about earlier, right? So when it comes to investing, uh, see why you come to mutual funds, because there are professionals there who are managing the money that you are investing. So it's your hard earned money. You're saving in a very hard way, and you should do justice, because if you don't invest with enough knowledge, then probably you're taking a very high risk. So for all those who do not have time, inclination, or knowledge of markets, should avoid speculating, because if you're investing without those three things, then you are speculating in markets. Whereas it should be more methodical, more research based analysis, and that decides where you invest into. If you don't have those three ingredients, better to go to a professional who has a team of people and whose main job day in and day out 24 by 7 is to look after your money. And that is where mutual funds do just exactly that. And that is why you should go to mutual funds. Mutual funds will have good teams, they'll have good support teams as well. Plus they are qualified people. So, would you kind of treat yourself, or would you go to a doctor? It's that at if you have a, because this is your hard-earned money, and if there is a disease that you've got, would you try treating it yourself? Is that risky, or would you go to a doctor? Similarly, if you think that you should go to a doctor, similarly you should go to a professional for your money and ensure that it grows methodically over a period of time. So mutual funds are very, very efficient vehicles. They are very transparent. The cost of investing has significantly reduced over a period of time. So it has all the key ingredients that you're looking for when it comes to investing your hard-earned money. So mutual funds will do enough justice. They will have various solutions for you, be it if you don't want to take high risk, if you want to take high risk. So they will have different products, right, from debt, gold, multi assets, etc., which will provide you the solutions that we are looking for. And there is an investment objective. If it reconciles with what your aim is, then probably choose those funds and invest your money there so that you reach your goal and get the adequate risk return profile on your investments that you're looking for. So,
Okay.
so rather than doing it yourself, you should try and use the professionals so that they take care of your money and ensure it grows over a period of time.
Absolutely. Matlab, professional advice is always better than to pick stocks, right? Stocks, probably we might have some knowledge, but we may not be expert as the professional team of fund managers might be having. So it's better to hand over the responsibility to the professionals to do the needful. So in fact, Chirag, the second question I'd like to ask you only. In last 1 month, we have seen tremendous market volatility. The market has come down, and today has been a fantastic bounce back. So, do you think? And again, the valuation seems to be pretty attractive. Indian story is also intact. So, do you think if anybody willing to invest or sitting on the sideline, that he should be putting his money lump sum in the market straight away, go ahead and invest, thinking that correction probably is more or less over, or what you advise to such kind of investors? To you, Chirag. Yeah.
Yeah. So markets have corrected from significantly higher levels to what they are today. Even from a valuation standpoint, they have become attractive, very close to the long-term average levels that we are staring at. The long-term average level is closer to 19.7 times on a historical PE, whereas we are currently at around 23 times. So overall, we have seen a sizable correction in markets, and valuations have become attractive. Does not mean that much of the some of the uncertainties are over. Much of it is priced in, as you said, but there could be input cost pressures given the inflation trends that we are seeing. But having said that, markets have become a lot more attractive and conducive for investments than they were before. So if you're an investor looking to put in a lump sum money in markets, probably next from now to next 3 to 6 months could be a great opportunity. It will be very difficult to say when the market will bottom. So we will say that gradually you should kind of enter the markets over the next 3 6 months. Maybe you can break your corpus that you have maybe in three tranches and enter the markets. Because much of the risk are priced in, be it the global uncertainty, the interest rate increase that or the tightening stance globally that we are seeing from central banks, the inflation and trends that we are seeing. So overall, much of those risks have been priced in. There are pockets of opportunities emerging in various sectors that will give a great entry point to the fund managers to kind of mold their portfolios in the right manner. So if you're an investor looking for investments, maybe now you could start and slowly increase your allocation to equities over next 3 to 6 months. We think that India is on the cusp of an economic revival. It was rather moving very well. Uh, what we saw is inflation kind of pushed back the growth that we were seeing. So the cyclical recovery that we were seeing in markets was similar to what we saw in the period of 2003 to 2007. And we are in a similar trajectory. It got pushed or delayed a bit because of inflation trends globally, because of the war in Russia, Ukraine, and it kind of accelerated the inflation pressures that we were seeing. But barring that, from a growth perspective, even from much of the selling that we were seeing from FIIs may subside now. And given the growth rates that India stands at relative to other emerging market economies, to other global economies, is very respectable. And so we should also start seeing resume some flows coming back to Indian markets over next few months. So overall, the trajectory looks really good. Uh, and from now to 6 months will be a great entry point for investors.
Okay. Now, one of the reasons that market has been falling, Chirag, is lots of FI outflows. FI has been relentless selling for last 1 year. So, do you think market being attractive now, FIs come back? Do you see they will be coming back to Indian market sooner or later?
Yeah, so it's not the first time that we have seen that FII outflow happening. Whenever we've seen that global tightening cycle start, we have seen those outflows on many occasions. So we have seen this cycle before. Uh, Also, if you were to put India on a relative valuation map globally, maybe 6 months back, or even few months back, India was relatively overvalued as or compared to the likes of other emerging market economies. But now with this correction, some of that overvaluation has been bridged down, and given the growth rates and the cusp that we are seeing from a political standpoint, from a growth standpoint, from if you look at our forex reserves as well, are significantly larger than many of the other economies. So overall, India is better poised, and hence we are confident that the FII flows will resume for the growth that India offers to them. So with this correction that we have seen, much of that overvaluation concerns going off, uh, and we should see FIIs enter over next few months on the buying side of the market.
Great. Thank you, Chirag. So, my next question is for Aditya. Now, as Chirag says, that yes, it's a good time, attractive time. Indian market is better poised than lots of other international market, and also maybe in next few months, FIs will start coming into it back to the Indian market. So, considering all the factors, Indian story is intact and everything, can you suggest some funds or categories of funds that one can, to help kickstart a new investor in his investing journey? What kind of fund categories or kind of funds that you would like to suggest, Aditya?
See, if you're new to the markets and you want equity exposure, and you don't know anything how to invest in a mutual fund as well, plain, go for a passive fund. Passive fund, by passive fund, I mean those that track the Nifty 50 index or the Nifty Next 50 index, or something of that sort, where it is passive and you don't have to apply much brain towards it. Uh, Broadly, I would suggest to split your money between active funds and passive funds. Have your leg in both baskets. Do not take a call that one of them will outperform or underperform. That's the first point that is there. The second point is that go for diversified funds. Look at a flexi cap fund. It's good to have exposure across a small, mid, and large cap that is there. Then, as per your risk profile, if you are very young, then you can also look at a small cap portfolio, small cap mutual fund that is there. However, it all depends on your risk profile. Young people can go towards small cap funds. If you are in your medium, if you are in the middle age of your life, then you have to control your risk, not take too much exposure to the small cap side of things that is there. So broadly, it will depend on how your life age is progressing and what is your risk profile. If you are very new to the markets, I will suggest go towards index funds, go towards passively managed funds, while slowly learning how to invest in mutual funds. If you don't know how to invest in a mutual fund, hire a distributor or a SEBI registered advisor who can advise you on how to invest as per your risk profile.
Okay. Aditya, actually, you have picked up another very interesting side, that is passive and active investing. And also, you brought in the risk, the age factor to the whole thing. So, first, again, how would you advise a retired person, a person who has just retired, probably is going to retire, but never took any risk by investing in mutual fund or something? What kind of funds that he should
Very,
invest?
yeah. Yeah, very simple. When you are very close to your retirement, your equity exposure should be cut to minimal. I assume that you have already invested for about 10 to 15 to 20 years of your life and you have sufficient amount of corpus. As you retire, the primary aim is to create a fixed income that will replace your regular income so that you are able to take care of all the expenses that you may really have. So, debt mutual funds, debt products, they are a good option. You can go towards fixed deposit. You can go towards debt mutual fund. However, in debt mutual funds, don't go towards very risky funds or the credit risk funds. Just in search of some high return that is there. Go for safe, good products that are there. Right now, as we are going on an interest rate hike cycle, you have to cut duration to a large extent from your portfolio. Go towards short-term debt funds or ultra short-term debt funds. Those will be okay. So the point is, when you are retired, equity exposure should come down to minimal, and your debt exposure, which helps you create passive income or regular income, those should dominate your portfolio.
Okay. So again, passive income, like you were talking about ETF, index ETFs, like you talk about Nifty 50, Nifty Next 50. So, what are the pros and cons of both the funds? Because lots of people seem to be interested now because the market is down between Nifty 50 and Nifty Next 50 ETFs. Can you just
I could not hear your question. Can you repeat that, please?
okay? What I was saying is that because the market is down now, lots of people are interested in ETFs as well, right? Again,
Yeah,
passive investing. Now,
yeah.
since you have spoken about Nifty 50, Nifty Next 50. So where do you recommend? Which one is more attractive? Nifty 50, Nifty Next 50. What are the pros and cons between both the ETFs? And
Yeah.
again,
So
before that,
first
if
of
you
all,
can,
yeah,
yeah.
yeah. Please go. Sorry, please go.
Again, if you can just tell our audience about ETF as well, because again, it's a kind
Yes.
of
Okay.
mutual fund, but we can bring in
Yes.
this aspect
Correct.
as well.
So yeah. So first of all, I will differentiate between active funds and passive fund. For example, uh, both of them are mutual funds, but on one side on one side, which is the passive fund, there is no fund manager as such. It will track a well-known index in any country. For example, in India, Nifty 50 is a well-known index. So what a fund manager will do, there will be no active fund management. Only when the index changes the composition of the mutual of its own index, only when the index manager changes the composition of its index, the fund manager will go ahead and try to change the stocks that are there. It will closely mimic what the index is doing. There must be some tracking error. However, it will closely mimic what the index is really doing. So broadly, you are trying to get what index return is there. So the fund manager risk is out of passive funds, and you will get index returns. However, there will be no outperformance as there will be in active mutual funds because you have taken out the fund manager risk. On the active side of it, as Chirag is there and Quantum Mutual Fund, you will find there is a fund manager who will charge you some amount of fee which is higher than a passive fund, and he will try to deliver superior returns than an index. That's the second point. The third point is I want to make it perfectly very clear. Your investment journey should be market agnostic. Markets may rise or markets may fall. Your SIPs must keep continuing. You should not take a view as a retail investor about what the market is going to do over a period of next 3, 6, 10, 12, 15 months. We as fund managers also cannot predict. So how would a retail investor try to predict, right? So my only point is, if the market is up or the market is down, don't worry about it. Try to invest in SIP mode slowly and steadily into the markets. Take the market up and down, या market पे क्या लगता है thing out of your system, and just try to invest properly in the market. Now, about Nifty 50 and Nifty Next 50. See, Nifty 50 is the topmost 50 companies of India, which the index feels should be there inside the index, right? The Nifty Next 50 is, those are the next 50 companies which are just getting ready to get included in the index, right? So there's a little bit of higher risk. They are in the Nifty Next 50 index that is there. It is a little bit more volatile than the Nifty 50 index. However, both of them are good. You have to assess your risk profile before investing in them. And as I said, all of these investments will be long term. We have already seen a little bit of correction in the index. However, if things go wild, you have to always be ready for a 30, 40, 50% correction in equities. So my broad point is, that is why I say keep doing regular SIPs. Regular SIPs, take that out. What will happen to the market tomorrow or day after tomorrow?
Okay. Thank you, Aditya. In fact, Aditya, you said again. I'm going to ask this question to Chirag. Aditya, right at the beginning, said that before you start your investing journey, you should invest in insurance. You know, emergency funds, insurance, and all these kind of things, so that you are secured. Now we have got a product called ULIPs. ULIPs are insurance product, but very much related to mutual funds. So, what is your take, Chirag? Do you think that insurance and mutual funds should be kept completely separately, or ULIPs are also a kind of options that one can look into? Yeah, the question is for you, Chirag. Can you hear my voice?
Okay, sure.
Yeah,
So probably, I think we strongly believe that insurance and investing should not be combined. It should be kept very distinguished and separate. You know what the instrument will deliver, because there should be no anomaly, because uh, you don't know what cost you're paying for what you're getting, either be it insurance or be it investing in a ULIP. Whereas in a mutual fund, you know what kind of where you're investing, does that suit your risk appetite or not, and what kind of returns or the predictability of the performance that you will get from that investment. And on the insurance side, I think terms insurance, you know exactly what cover you're getting and what premium you're paying to get that cover. So it becomes very easy for you to track, monitor, invest, and decide that what you're getting into. So overall, I think even when it is combined, it is very difficult to ascertain what are the different costs that you're paying, and then as a package, what is the overall, is it good enough or is it not good enough, and makes comparison very difficult. When you separate it, it becomes easy to compare and makes your life much easier. So I think uh, when it comes to investing and insurance, you should keep it very separate.
great, great. And now again, yeah. So one more thing about nowadays, we are talking about dynamic asset allocation funds, are also known as balance advantage funds. Yeah, can you just educate our listeners on that? Why is it a better kind of a mutual fund to invest in? Chirag?
Yeah, sure. So dynamic asset allocation funds, just whoever is not aware of it, is a fund which kind of invest into at least two asset classes, or sometimes at three. Usually they'll invest in equity and debt. We believe that multi-asset funds should be kind of into three asset classes, because those three are easily investable. Real estate that Aditya spoke about earlier is not easily investable; it's illiquid, etc. And so any fund that is dynamically allocating means depending on the attractiveness of asset class at that point in time, they will increase or decrease the allocation to that asset. So one fund which will have different allocations to equity, debt, and gold at different points in time. So that the fund manager will say that equity markets are expensive today. Let me move out of equities and move into other asset classes which will protect value at that point in time. And when equity is correct, and I will increase my allocation at that point in time to benefit from the up move that will come. So those are dynamic asset allocation funds. Given that you as an investor cannot know when the markets are overvalued, when is the right time to invest, those dynamic asset allocation funds do that for you. So it's a solution being offered by the mutual funds. And when it comes to a dynamic asset allocation fund, uh, please ensure you understand where you're getting into, because different dynamic asset allocation fund will have different ranges of asset allocation to different asset classes. Please choose a fund which is very well balanced and not biased towards a particular asset class, because we have seen many funds to get the equity taxation are biased towards equity as an asset class. So they will have minimum 65% allocation to equities. So if we are so highly exposed to equities, why not be in a direct equity fund is the question that we usually ask ourselves. So when it comes to the dynamic asset allocation fund, choose funds which are very well balanced. Because if it is minimum 65% allocation to equities, even if the fund manager is uncomfortable with the markets, if the markets are very overvalued, the fund manager will not be able to take it below that 65%. So if it's a big range, like for example 25-65 or 0-100 or 20-80, those are the funds which have enough flexibility for the fund manager to be able to exercise that dynamic asset allocation for you, and those will be the right funds for you to invest. So, a dynamic asset allocation is for investors who are kind of not able to take the call on asset allocation, or unable to decide how much to invest at what at a particular point in time in which asset class. Then, for those investors, these are great products or great solutions being made by the mutual funds. And if you're in aggressive allocation funds which have equities higher, then there is a higher risk. If there is enough flexibility, then that allows the fund manager to reduce risk. So these are great solutions, but you need to understand which kind of funds you should invest in and just select those for your investments.
Great. Thank you, Chirag. Now, again, Aditya, my next question is for you. Lots of people approach investing from the tax planning perspective, right? They want to plan for taxes. So, which will be a better option? PPF, ELSS, NPS, or bank deposit from the tax planning perspective?
See, all these three products are very, very different products in their structure. So, if you look at a provident fund, the major drawback of a provident fund would be it has a very long lock-in period. However, it's an exempt product, so it has a big advantage there from a taxation point of view. That whenever you redeem your taxation or whenever you redeem your investments, the entire corpus together with the interest is completely free. That's the first point. However, there's a con of a very, very long lock-in period. When you look at the equity mutual fund or the ELSS fund, it has a very short. It has got the shortest lock-in period of about 3 years. However, now with the long-term equity tax coming in, the long-term capital gains tax coming in, every year any gain above 1 lakh is taxed at about 10%. So that's the con of it. However, and of course, 3 years is a very short period of time to do anything in equities. It could be possible that the market does not do anything over a period of 3 years' time, and you may not make any returns. So that's that. And then there's a very good product that has come up, which is called the National Pension Scheme. Again, it has an ultra very long lock-in period at about your retirement date, which is about 60. So all of these products are very, very different products in nature. You have to evaluate the pros and cons of each of these products and see if that really fits inside your portfolio or not. If it does not fit inside your portfolio, even though if it is a good product, you cannot have that inside your portfolio. So uh, evaluate all of these products, the lock-ins, the investment horizon, and other features of these products, and then evaluate if you can invest in these products or not. Hello, hi, can you hear me? Hi, Neeraj.
Neeraj, I guess you're on mute.
Oh, yeah, yeah, yeah. So thank you, thank you. So I think for a new investor, the preferred route is definitely mutual fund, as we all agree. But again, direct equity also cannot be avoided. Many a times people really, really, they get tempted to invest in direct equity. So, do you have any advice as to how much of his portfolio should be devoted towards direct equity? Number one, and number two, how to choose the right stock in case somebody wish to go for a direct equity. So, Aditya, if you can answer that.
Uh, simple rule. If you, as Chirag said, if you are not a doctor, then don't go ahead and treat the disease that is there. Very simple. If you don't have the time, if you don't have the ability to research well, to invest your time in finding out what the underlying businesses are really doing, your allocation towards direct equities should be completely zero. You should go ahead, either invest in a mutual fund or have a PMS or have a RIA. However, without research, there should be no investment into direct equity. If you want to, if you're really very curious, you are very passionate, and you want to learn about stocks, so there is ample amount of information available today. You can go ahead and look at con calls. You can go ahead and look at presentation. You can go ahead and look at interviews that management give on TV. However, as I did say to everybody, stocks are like your babies. You have to keep on constantly monitoring them all the time. Every quarter, these companies come up and give results, and you have to consistently and constantly keep monitoring. Which, if you have a job, is very very difficult to do. For us, as our 100% of fund managers' time is only invested in trying to analyze those companies and figuring out what is happening. So it is much more convenient for us to do rather than any retail investor. So my suggestion would be, if you have time, if you're able to properly analyze, go ahead and invest in the direct equity. But if you don't have time, and if you are in your job, don't invest in direct equity. Take the mutual fund route. It is the best route for retail investors.
Okay, great. So Warren Buffett says that when everybody gets greedy, one need to be fearful, and when everybody is fearful, then one needs to be greedy. So definitely, so as I go by Chirag, probably, I don't know, maybe a little bit of greedy one need to be, right? So what's your pro tips, final pro tips as we close our whole discussion today? Chirag, what is your pro tips to our new investors, would be investors, to become successful in their investment journey?
Yeah, so I think the best advice that I can give you is listen to what everyone has to say, educate yourself, and make the decision with your eyes wide open. I think you should never go for a six on every ball. So save, invest sensibly, and be patient with your investment. Whenever you're looking at portfolios, I think the four P's that are there are very very important. People, what is their background, what is their experience, the philosophy, are they just a one market manager? Whenever market goes up, they do well, or they kind of are consistent performers? What is the process? Process is very, very important, because what we have seen day in and day out, whenever the fund managers change, much of the portfolio changes. That's our experience running the equity fund of fund where we invest in other managers. Funds with a very good defined process, research and investment, are the ones that you should rely on. And what is the performance? When I say performance, you should look at long term performance, but also predictability of that performance. Whenever you are investing in a manager, you should know, if market is doing this today, my fund will do y. Why my fund should be performing in this manner. That's the predictability of performance. That tells you how well you have understood the manager, their philosophy, their process, and that gives you that confidence in that manager to invest into. So always, look for managers who back great companies, companies which have great governance, great management. I'll agree with your point that it's slowly getting to the point where we should start getting greedy, but invest sensibly. Don't take leverage yourself, or don't look at leverage or high debt companies. You should avoid that. because whenever that is one of the very important risk that we monitor in companies. Companies which are high leveraged are kind of have that high risk of going very, because if there is a bad cycle where they get caught into, then it gets very very difficult to for that business to survive. So overall, debt at your personal level, debt at your company level, please avoid that. And again, I will repeat that, save, uh, save your hard-earned money that you have got. The formula that you should have for saving is your income minus your saving should be your expenses, and not the other way around. Usually, what people do, whatever income minus expenses becomes your savings. Whatever is left over is your savings. It shouldn't be that way. If you want to reach your goals, if you want to build great long-term wealth, then you should determine what kind of savings I need to reach that amount. Invest sensibly, invest where you understand which products you understand, familiarize yourself with the risk and return, and then invest and be patient with your investments.
Great. Thank you, Chirag. Thank you. Now, Aditya, as we said, probably it's a little bit time to become greedy, but at the same time, we should not borrow money and take loan and start investing, right? So, Aditya, your pro tips for our new investors to start.
Very, very simple. I have a mantra of keeping things very simple. Stay disciplined, stay consistent, follow all those four processes of insurance, emergency corpus, risk profiling, asset allocation. Stay consistent, stay disciplined. Don't have a view on markets. SIP a good fund for 10 years, and you will see the eighth wonder of world, which is called compounding. So don't worry about it. Have a SIPs continue. If the market is up, don't be euphoric. If the market is down, don't panic. Continue on SIPs, and you will be good to go.
So, gentlemen, thank you so much for sharing your insights, Chirag and Aditya, both of you. We had a wonderful conversation, although we had some kind of a technical hiccup right at the beginning. I'm sure our participants could get lots of informations from our discussions here today. I really appreciate for joining today in the evening. To all the listeners, all the participants, thank you so much. Keep joining. We'll keep on doing lots of small sessions like this, and from every sessions, if you can derive some kind of small bits and pieces of wisdom and knowledge, that is a great help to to be to for a successful investment journey. With that, I would like to close the discussion today, thanking all of you, everyone, our guest Aditya and Chirag, and also our host, uh, every one of you, and all the participants. Thank you. Have a good night.
Thank
Thank you.
you.